Hello and welcome to Tax Tip Tuesday. I'm your host, Chastity Grady. I'm the owner of Grady Tax Plus, where I have service-based business owners who are new in their business, understand their business structure, their taxes, and help keep their finances organized. So today, we're going to talk about standard versus itemized tax deductions, okay, on today's Tax Tip Tuesday. So if you're watching live with me, definitely let me know that you're tuning in. Let me know where you're tuning in from. And if you're catching the replay, comment hashtag replay so I know that you caught the live. Okay, so let's go ahead and get started. I do want to talk about some of the myths that comes along with standard deductions and itemized deductions that a lot of people don't understand, and also talk about the difference between the two. Okay, and also some of the myths with itemized deductions, because a lot of people think certain things that are not true, and so I'm gonna go ahead and talk about those for y'all. So when it comes to the standard and the itemized deductions, you only can take one. All right. So you either take the standard or itemized. Now the IRS, they're really nice to us, right? So they increase the standard deduction each year based off, inflation or whatever rules that they have. But they have a standard deduction for people who are not able to itemize to get a higher deduction. So single head of household, married, filing jointly, separate, and qualified widow or survivor, they call it now. They all have their different classifications of what is a standard deduction that you can take in order to reduce your taxable income that is subject to federal taxes. All right. So, but on the flip side is that if you itemize, the point of itemizing is to get above what the IRS is already standardly given to you. Okay, so that's the whole point of itemizing. You want to itemize if you feel like, as a married filing joint person, if I feel like I can get my itemized deductions above about $26,000, then it will be, then the itemized deduction will be in my favor, right? But the issue with itemized deduction, there's only certain categories that you're able to itemize, right? So as you can see, just off the bat, with the standard deduction, if you don't know what you can itemize, then the standard deduction is probably what you're going to take on your tax return. So let's look at some of the itemized deductions so you can kind of see how some people may or may not be able to itemize, even if they do have some of the things on this list that I'm going to share with you. So when it comes to like medical and dental expenses, right? People think that, I spent $5,000 in medical expenses this year, so I'm able to write that off. No, that is not the case. All right, just because you spend $10,000, it really doesn't really matter the amount. What matters is if that amount that you spend is 7.5% of your adjusted gross income, if it's more than that. So if your adjusted gross income is $100,000, 7.5% above, so whatever the 7.5% is, you have to have your medical and dental expenses be more than that. And so I have a calculator. I'm going to pull it up real quick because I did not do the math before I hopped on here. So that's $7,500. So basically, if your medical expenses is not more than $7,500, then you can't even itemize it. If you're based off of $100,000 AGI, which is your adjusted gross income, sorry. So based off that, if your medical and dental expenses are not above $7,500, then you won't be able to itemize it. So that's one of the things. Like people, like I said, you think, just because you spend a certain amount, then you might be able to itemize, and it's really off of your adjusted gross income. Okay, so 7.5%. That's the only way. And even that, so let's say you did have over the $7,500. Well, it has to be enough over that in order to get the deduction. So it just, basically if you have $7,501 that you spent, then basically the $1 is what you could take as a deduction. All right. So if you don't have like maybe $10,000 for this example, then you could take $2,500. But if you don't have anything else to itemize, that $2,500 is a deduction versus what your standard deduction is, and your standard is going to be higher, so it still wouldn't even matter, right? So you see how it's kind of hard for you to even start off with getting the itemized deduction if you don't have a lot of the things in different categories to itemize. So another thing, interest from your mortgage. So if you don't even own a home, then you don't even qualify. So far you're still left with that $2,500 if we're going off the example we're using right now. So, but if you do own a home, then you can write off the interest of the home. Okay, the interest. So if your interest of your home is $10,000, then now we're at the 25. Not 25. We're at 12,500. Okay, so that's where we're at. So even with me as a married filing jointly person, that 12,500 itemized deduction is still not enough for me to not use the standard deduction. Okay, so it's still putting me at a disadvantage. But as a single person, if I have a couple more things, then maybe the itemized deduction might work. Because typically the itemized deduction is beneficial for if you're single, really. If you have all of the things in the category to itemize. So another thing to consider is the state and local taxes paid. So if you have, so if you own a home, then you have real estate taxes, you have property taxes. And so normally that's what's going to help you bump up your itemized deduction from, because you have that interest. So with the interest tied into the property taxes, that's normally what's going to put you over what the standard deduction is for a single person at least, okay? So you have the real estate taxes and then any sales tax paid on general sales. Now, most people are not keeping up with this, just to be honest. Basically, if you go to the grocery store and the sales tax you paid was 10 cents, keeping a whole bunch of receipts and stuff with 10 cents, 30 cents, whatever the sales tax is on whatever you paid. As you can see, that's really tedious. So a lot of people aren't really doing that. But if you can do that, the limit to claim the state and local taxes paid is $10,000. So if you can save a whole bunch of receipts to get to that $10,000, then that might be beneficial to you. But like I said, most people are not doing that. Most people are not doing that. Some people are who are real, tedious about it. They are doing it, but for the majority of the people, they're not doing that. For the state and local taxes paid, normally they're just taking their real estate tax as a deduction part of that. And then obviously we know about charity deduction or charity gifts to charity. Qualified charities according to IRS standards, so it can't just be somebody saying they're a charity. It needs to be 501(c)(3). You can find a list of qualified charities on the IRS website. So the charity deduction in the past, it was $300 for a single, and then $600 for a married filing jointly. But the IRS has done away with that. So if you're somebody like me who was hoping that gifts to charity was going to be $600 again, then sorry to tell you that it's not. For married filing jointly. So if you did not proactively contribute to charity throughout the year in 2022, then you're kind of looked out on that charity deduction, because as you know, like I said, the goal of the itemized deduction is to get over what the standard deduction is. So you have to if you didn't contribute, for married filing jointly over $20,000, then there is no point of even looking at that. And then the casualty and theft losses, okay? Casualty and theft losses, the casualty has to be federally declared, and the IRS does have a website where you can check to see if certain things were deemed federally declared in order to take that casualty and theft loss. Most people that doesn't pertain to them unless you are in certain states where things happen, like Florida or Louisiana for 2022. I don't think any other states had any issues. I can't remember. But like I said, so basically when you look at the medical expenses, charity, interest paid on your mortgage, state and local taxes paid, casualty loss, and there's other itemized deductions. If the total of all of that is not more than your standard deduction, then guess what? You do not qualify to take an itemized deduction, okay? The standard deduction will be more in your favor. So if you're working with someone, as a taxpayer, if you're working with someone who, who maybe I'm not gonna say dismiss, but someone who basically dismisses you bringing in medical expenses or something like that, it's likely because you're not gonna qualify, and there's no point, but there's no reason to include the information on the tax return if you don't qualify. Now, we can put it on there just so you can see the difference between what the itemized was and the standard, to show you why the standard was a better, deal for you. But for the most part, if you don't have the interest for a mortgage, real estate taxes paid, those two things alone helps you, get in the realm of you even qualifying for itemized deduction. So if you don't have those two, then you probably you won't qualify for itemized deductions. The medical expenses, you have to have a whole lot of medical expenses, in relation to your adjusted gross income. So if your adjusted gross income is pretty high, you have to have, your medical expense amount has to be really high really high as well in order to get that 7.5, get over that 7.5 percentage. If you have a lower income, then it's not as bad. The 7.5%, qualification is not as bad. But if you have, well over 50,000 a year, 6 figures, you have to have some, major medical issues going on that you paid out of pocket, not that your insurance paid, okay? That you paid out of pocket, co-pays and everything. That's what qualifies you, all right? So again, the standard deduction is typically what's going to help people, lower their taxable income. If you're single, you own a home, then you're most likely off the bat, you should be able to itemize your deductions, because for the most part, the real estate taxes and the mortgage interest alone by itself should qualify you over that $12,000 amount. Okay, so that's what I want to talk about, the standard versus itemized deductions. If you have questions, definitely leave me a comment. Schedule a consult with me if you want to understand more about the deductions that you could take. And this is for on the personal side of your tax return. I talk about business, a lot, so I wanted to at least address the personal side for people who might not have a business, or for people who also deal with this. Everybody is going to deal with the standard versus the itemized, but specifically for people who don't have businesses. And basically, this is all you have in order to lower your taxable income outside of credits, okay? So if you have any questions, definitely leave a comment. Hashtag replay in the comments if you are catching the replay, and schedule a consult with me if you need to for tax and bookkeeping services. I'll leave my link in the comments. And that's what I have for y'all for Tax Tip Tuesday today, and I will catch y'all in the next one.